Should you invest in shares or property? Let's have a look. Hello everyone, Florian.heise here, and welcome to another episode of HeiseSays. Grab your morning stein of coffee and let's have a look at this article from Yahoo Finance, because it's asking the question that, well, a lot of people will consider. Should you invest in shares or property in 2020? We should probably also add to that, should you invest in precious metals in 2020? So let's have a look at this. The $64,000 question, shares or property in 2020? Shares or property is the $64,000 question, although perhaps we should call it the $640,000 question, given how much a pandemic economy has upped the economic ante. Both should be thought of as long-term investments. Property, very long-term. Both have extra costs. Properties are much higher, unless you can get first home builder concessions. More on that important and expiring home builder consideration in a sec as well. But you should buy a property as a single asset investment only when you are ready, not when you are rushed, as may be the case now. Now that is a fantastic point. And really we're not hearing that reiterated enough in the media, are we? Because that's what all of these interventions in the market are designed to do. They're designed to encourage, manipulate, nudge you along to, well, buy. And how many people are we seeing in our circles of friends, online, sharing on Facebook? Just got into debt, just bought this fantastic house. And I'm seeing, thinking, are they not watching the same news? Are they not looking at the economy? Think about it. You've got mortgage holidays that are going until March, with the potential to be extended further. We heard that last night in the House Economic Standing Committee, at least some of the comments from Governor Philip Lowe. There's the potential for it to move to interest only. But then what happens when that all starts dripping off? When people start to get the tap on the shoulder and need to do the forced sales. It's the last sale in your street, in your neighborhood, in your area that affects the valuation of your property. So if you rush in buying now when it's all overheated, because you've got people with this government handout, that state government handout, this exemption, with another 45 grand, then the super they've pulled out as well, thrown on the top for good measure. Why wouldn't you wait? Rents are getting cheaper. Hold out a bit longer and see what happens. Don't rush. There's always going to be lots of other houses. There's lots of houses. Lots of them, guys, everywhere. And you don't need to stay right where you are. Maybe you move somewhere else. Maybe you'll look at other opportunities. There's one of the issues that Governor Philip Lowe raised, which I thought was very good, was just the fact that stamp duty, it reduces mobility of our workforce, of the people here in the country. If you're buying a house, you get stung with stamp duty every time you're moving around. You sell and buy again. So that limits people's options. Maybe wait a bit longer, stay in the rental market, and keep that flexibility. You don't know what's going to happen this year or next year. What if you just bought into Victoria and then boom, all of these restrictions come down and you are ideologically opposed to such restrictions on your personal freedom and you want to get out? And then in 6 months' time, when it all opens up, you decide, okay, I'm going to get out. Oh, look at that. You've taken a 20, 30% hit on your investment or on your home. So let's get back to this. Meanwhile, shares, where it's possible to diversify widely to minimize your risk, you should start cautiously buying today. Let me explain. So she's making the argument to get into shares as opposed to property. Now, let's jump over to trading economics, everyone, and let's just have a look at how the ASX 200 is doing. So here we have the ASX 200, and it's been hovering around 6,000, and it's starting to climb up again. It's starting to climb up again. What's the Australian dollar? Is at 71.70 cents. Now, the question is, in the businesses that comprise the ASX 200, has the market priced in the reports that are coming out, the negative reports that we're getting? We just saw yesterday warnings from Flight Centre about massive losses. I can't imagine anyone would be surprised about that. And the hope is people are buying into these businesses that there will be a recovery and a return. Now, there's the question, will there be a recovery, everyone? Because what we don't want to happen is this one right here. Like Hertz, where everyone saw it was cheap. Psychologically, they were used to Hertz being valued at like $20 or $18. And then all of a sudden dropped to 4. So they thought, wow, fantastic. V-shaped recovery, here we come. So they all dogpiled in. And, is this the trough? Have we hit the trough here in the ASX 200? And is it steadily going to climb back up? Or the fact that we still have so many interventions into the economy? Do they mean we haven't seen a trough yet? That's the consideration. So let's jump back here. What you need to know about the COVID economy in property. Right now, there are huge incentives to buy new developments or to renovate your existing home. The Home Builder Scheme aims to prop up the building industry with a $25,000 cash grant for people who buy or build new homes, valued up to $750,000, or who renovate to the tune of $150,000. The grants are available to Aussie singles who earn less than $125,000, couples who earn under $200,000. You must have contracts signed by the 31st of December and work must commence within 3 months. Now, has she mentioned... She hasn't mentioned anything about the fact that right now we have the liabilities that directors face. Like, as a director of my business, if I'm trading while insolvent and knowingly take on contracts or take work from other people and say, yeah, I'll pay you later, I could be held personally responsible for that because I was knowingly trading while insolvent. Now, that's disappeared. My concern is with all of this stimulus in the building sector, with that gone, you're going to have builders that are running on the line or trading while insolvent going under. And then people are going to cop it. Hopefully I'm wrong. But we've seen in other articles, just the number of insolvencies are down. First home buyers have also existing concessions and incentives available to them, which differ by state, particularly if you buy a new property. But it may well be, if you keep under the same $750,000 price point as home builder, you could also avoid stamp duty altogether. This is one of the biggest expenses of a new home. The other large expense is lender's mortgage insurance, and there are ways to avoid this now too. First, there is the government's First Home Loan Deposit Scheme, which allows you to buy with just 5% deposit instead of the normal 20%, which is usually required to avoid lender's mortgage insurance. You borrow 95% and the government guarantees you for the 15% extra you need. However, I urge caution on that one at the moment. 5% is not much of a buffer if property prices temporarily fall on the back of an economic hit, and you'd find yourself in negative equity owning more than you owe. There is also an interesting product, though, from St. George, where you only have to pay $1 in lender's mortgage insurance with a deposit as low as 15%. But in an ideal world, a 20% deposit gives you a greater margin of safety. If you have such a deposit, have been thinking of buying, and could access the home builder and other concessions, then now could be a good opportunity. If not, as I said earlier, the time to buy is when you're ready, not rushed. I think that's just the general rule of thumb for everything, to be honest, but even for shares. And there's another, well, she's putting forward two options, one regarding buying a house, one regarding buying shares. What about maintaining in cash? What about maintaining in foreign cash? What about putting it in bonds? What about precious metals? They're never really considered or discussed. They're just not that popular with the average punter. It's only one or the other. Let me know in the comments, guys. Gold and precious metals are becoming more popular. It feels like it, but it could just be the content I'm consuming. No. How many people have you met that look at you nuts when you say, oh, just, put a bit of money in some gold, put a bit in some silver, just in case, to hedge yourself against a, potential hyperinflation incident, or a way to protect yourself against a huge crash in the Aussie dollar if that should happen. May not, probably won't, never know. Can't hurt. So what you need to know about the economy regarding shares. The swing in the share market as it reacts to the roller coaster news flow has been extreme. The so-called fear index over the US S&P 500, the CBOE Volatility Index, VIX, hit highs on worldwide lockdown in March, above those seen on the global credit crack-up. It has since eased, but you'll have noticed big day-to-day bounces regardless in both directions on the share market. Having said that, since early June, our top 200 shares have effectively traded sideways. To invest in stocks more safely, you need to invest small amounts of money regularly. By doing this, not only will you get exposure to the more stable trading environment today, you can take advantage of any return to volatility. A concept called dollar cost averaging basically refers to the fact you get more shares when prices are low, so enjoy a bigger portfolio boost when prices push up. So if we jump here and have a look, we can just see that sideways movement that she's mentioned. And of course, this author is arguing for a long-term strategy, not day trading or swing trading, just slowly building up an investment into the market. So this also saves investing a lump sum when it turns out the market is at a high point and subsequently falls. Well, dollar cost averaging, I say the same thing for kids, guys. You want to pump out a few kids, you dollar cost average the kids. That's it. But if you've never invested before, how do you get started? To obtain the diversification that I said was key for safety earlier, exchange-traded funds are great, especially so for novice investors. These instruments trade like shares. You buy bits or shares of the fund through an online broker, and then these move up and down in value based on investor sentiment. The beauty is you can buy exchange-traded funds that cover an entire sector or even an index like the ASX 200, so you get to, at very low cost, spread your money across far more stocks than you could afford. Pick the market or area of the market that you think might recover the quickest from the craziness and save $500 and repeat. The time to start saving and investing with small regular amounts is immediately. So, she's only putting two arguments forward. Nicole here is only putting two arguments forward. Shares or property. No mention of precious metals, no mention of other financial instruments. One thing with, if you're looking at this, one thing I'd suggest you would check out is I'm looking on my phone here for it, the ComSec Pocket app. Little app here that you can invest in. You can't see anything here because it's all white and I haven't logged in. But it allows you to invest in a select group of exchange-traded funds up to only, I think the commission is $2. Because remember, there's a commission every time you make a purchase. Just $2 for up to $1,000. So if you're wanting to just start getting small, that's one strategy to do it. And you just do it over time. The advantage of the exchange-traded funds is, as she's saying, you get exposure to a greater exposure to a large part of the market, but there are also fees associated with that because they charge you a management fee to do it, which they have every right to because they're managing it. What do you think, everyone? Are you going into the stock market now? Is the volatility too much for you, or are you holding back? Or are you a precious metals stacker? Gold, it took a dive. It's now down at, 1943. Silver's at 26.42. Apparently, 2 years worth of paper supply of silver, global production was dumped on the market in a day. There you go. I'd argue for diversification. Don't have everything don't put everything in, all your eggs in one basket. Spread them out a bit. And the most important thing is to educate yourself. I think there's really some good advice here. Take it slow and easy. Don't fall for the get-rich-quick schemes, guys, because they don't work. They only work for the criminals running them half the time when you see some of them. And if you want a good example, look at the video I did on the Cloud Token Wallet. A brilliant scheme, a crypto scheme, where they actually threatened legal action against me. I'm still waiting to be taken to court, guys. I don't think it's going to happen because one of the creators is now, I think it was arrested. So yeah, too good to be true, isn't it? Anyway, thanks for watching. Please like, share, and subscribe to the channel. Let us know your investment tips or hints that you're using. What's your favorite exchange-traded fund? Are there particular stocks you look at? What do you look at to invest? For me, I'm all still quite new at it. Just looking at it quite slowly. And I'm kind of sitting on the sidelines, to be honest. I think it might be worth just, jumping in a bit later. We'll see how it goes. As always, thanks for watching. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I create here, there are a few ways you can. You can join the channel on YouTube or Patreon. You can use our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin. You can buy a merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone. Have a great day, and I will see you all in the next episode.